As live trading pushes forward on July 21, 2026, Advanced Micro Devices Inc., trading under the ticker symbol AMD, is moving at $527.60 per share, surging upwards by $24.03 or 4.77% in intraday action. That jump comes on an active trading volume already clearing 9 million shares before noon. While retail traders across popular trading apps rush to chase this green candle, a far more complex structural repositioning is happening beneath the surface. Most investors watching their ticker screens see a simple story of a semiconductor designer catching a tailwind behind the broader chip sector. What they are missing is that institutional desks are not just buying short-term momentum, they are pricing in a structural shift in data center architecture that directly threatens the dominant market expectations surrounding hardware spending. The conventional consensus across Wall Street has long framed this company as a perpetual runner-up, a high-beta enterprise destined to capture whatever leftover demand spills past the market leader. Analysts and retail portfolios using an individual brokerage or checking stock feeds on the Robinhood app have consistently grouped AMD as a secondary play. The assumption was straightforward. If NVIDIA stock leads the charge in artificial intelligence acceleration, AMD simply gathers the remaining orders from cloud providers desperate for secondary suppliers. That expectation created a comfortable narrative where the stock was treated as a tactical hedge rather than a primary compounder. However, current market reality is breaking that simple template. The recent surge toward $527.60 reflects something much deeper than residual market demand. Large-scale hyperscalers are actively altering their multi-year procurement roadmaps to integrate custom rack-scale solutions, moving away from single-vendor lock-in. To understand why this price movement matters right now, you have to look at how capital is flowing across major trading venues. Over the past month, trading desks on the Interactive Brokers platform and institutional clearing networks have registered a distinct shift in order flow. While mega-cap tech mainstays like Apple stock have seen steady defensive accumulation, semiconductor capital has concentrated into high-conviction hardware architectures. Volume spikes on green days for AMD have consistently outstripped selling volume on pullback sessions. When the stock tested support near $595 just days ago, institutional buyers stepped in with heavy buy orders, defending that level and launching the share price back above $525. This price action demonstrates that institutional funds are not waiting for earnings reports to build positions. They are accumulating on any temporary weakness. Comment below how many shares of AMD you currently hold in your portfolio and whether you are buying more at these price levels or waiting for a pullback. This institutional footprint becomes even clearer when you compare how capital allocation behaves across different account types. Retail investors managing self-investing strategies through SoFi Invest, SoFi Active Investing, or Robinhood stock trading often buy shares in response to immediate headlines or short-term charts. In contrast, systematic funds managed through Schwab Intelligent Portfolios or wealth advisors using Fidelity Wealth Management look at supply chain lead times, silicon yields, and hyperscale capital expenditure budgets. Right now, those supply chain metrics indicate that supply chain operators are committing to long-term delivery schedules for advanced GPU and CPU deployments. The recent expanded partnerships with cloud behemoths serve as clear proof that hardware diversification is no longer an option for big tech, but an operational necessity. Looking at recent daily price swings, the stock has displayed exceptional relative strength compared to the broader tech sector. Over the past 3 months, while traditional software and hardware names experienced choppiness due to macro interest rate debate and shifting treasury yields, AMD has advanced over 80%. That outperformance was not a linear path. It involved sharp consolidations followed by explosive breakouts. Each time short seller interest crept up near resistance levels, squeezed shorts were forced to cover as institutional volume swept the order books. Whether traders execute through Robinhood cash management accounts, Interactive Brokers fees-efficient routing, or Fidelity brokerage accounts, the underlying tape tells the same story. Supply is constrained and demand from long-term capital remains aggressive. Macroeconomic pressures continue to play a distinct role in shaping day-to-day volatility. Inflation data, global trade policy, and yield curve fluctuations regularly trigger automated selling across index funds and Fidelity ETFs. Yet whenever index-wide selling dragged tech down, AMD has repeatedly shown quick intraday recoveries. When macroeconomic worries caused a temporary dip across major equities like Tesla stock and broader growth assets, buyers quickly stepped up to absorb the floating supply in silicon leaders. This resilient bid highlights a fundamental truth about current market mechanics. Secular hardware expansion is overriding cyclical macroeconomic hesitation. Investors searching for investment help or researching through top investing sites are noticing that semiconductor allocations have become the central engine of growth within modern equities portfolios. To fully grasp why this tension between expectations and reality exists, it helps to examine the underlying engine driving the enterprise. At its core, Advanced Micro Devices operates as a fabless semiconductor designer specializing in high-performance computing, graphics processing, and data center infrastructure. By outsourcing physical silicon fabrication to world-class foundries, the company focuses its resources entirely on architecture design, chiplet innovation, and software integration. Its core revenue pillars span across data center processors, client CPUs for personal computers, gaming graphics cards, and embedded solutions for industrial and automotive sectors. For years, the market viewed the enterprise primarily as a budget competitor to legacy chipmakers in personal computer processors. Past financial reports showed modest margins and intense price competition. But over the last several fiscal cycles, management executed a dramatic operational turnaround. By pioneering modular chiplet design, they reduced manufacturing costs while scaling performance beyond legacy single-die limits. Annual revenues surged from under $10 billion a few years ago to over $34 billion, with operating cash flows expanding significantly. That historical transition proved that the company could systematically capture server market share from incumbent giants. Today, that same engineering discipline is being applied to massive AI accelerator clusters. The critical question for investors navigating online investing platforms today is whether current valuation accounts for future catalysts or overextends near-term reality. At a market capitalization exceeding $800 billion and an elevated price-to-earnings multiple, the stock leaves no room for operational missteps. Wall Street price targets range dramatically, with bullish research desks setting high marks around $725, while cautious analysts maintain targets closer to $320. This wide spread in analyst expectations reflects the divide between those who see a temporary hardware boom and those who anticipate a prolonged multi-year build-out. Looking ahead, several key catalysts will dictate whether the stock breaks toward new record highs or undergoes a sharp valuation reset. The primary catalyst is the upcoming quarterly earnings release, where investors using SoFi Stocks tools or Fidelity mobile app tracking will scrutinize data center revenue growth and gross margin progression. If data center margins continue to expand alongside rising unit shipments, it will prove that pricing power remains strong despite industry competition. Secondary catalysts include software ecosystem adoption as developer tools mature to allow seamless cross-platform chip integration. However, risks must be carefully weighed against these opportunities. Supply chain bottlenecks at major foundry partners could limit maximum shipment capacity, capping potential revenue upside. Furthermore, if cloud infrastructure providers slow down their capital expenditure growth or decide to prioritize internal custom silicon, hardware vendors could face inventory adjustments. Trade restrictions and geopolitical regulations present ongoing variables for global semiconductor supply networks. For individual investors managing self-investing accounts, balancing these structural risks against the secular growth story is essential. Whether you execute trades through an interactive broker's account, SoFi Robo-Advisor, Robinhood fractional shares, or traditional Fidelity IRAs, understanding this market dynamic is critical for disciplined decision-making. The stock is no longer a simple speculative trading vehicle. It has transformed into a cornerstone asset of modern digital infrastructure. The expectations of yesterday framed the company as a secondary alternative. The reality unfolding today demonstrates an essential provider shaping the future of global computing architecture. In summary, Advanced Micro Devices stands at a critical juncture where market consensus is constantly playing catch-up to structural reality. Today's intraday move to $527.60 highlights that institutional buyers are willing to pay up for proven execution, data center growth, and architectural flexibility. While market sentiment initially treated this stock as a follower in the semiconductor hardware race, the underlying data reveals an enterprise establishing deep roots across cloud infrastructure. Managing risk while recognizing true structural shift remains the key to long-term market success. Disclaimer: this video